Hi, everyone. We are now going to review problems 10.1, 10.4, and exercise 10-23. We have Tristar Production Company began operations on September 1st, 2021. Listed below are a number of transactions that occurred during its first month of operations. We need to prepare journal entries to record each of the above transactions. So on September 1st, the company acquired 5 acres of land with a building that will be used as a warehouse. Tristar paid $100,000 in cash for the property. According to appraisals, the land had a fair value of $75,000 and the building had a fair value of $45,000. So, buying 2 assets, 1 price. We need to allocate the cost of those 2 assets according to their fair value. So we determine what's the total fair value of both assets, $120,000. So the ratio of the land's fair value to total fair value is 62.5%. So 62.5% of the $100,000 actually paid should be allocated to the land. Then we take the $45,000 for the building divided by $120,000 will give us 37.5%. So 37.5% of the value that was purchased was in the building. So we will debit the land, $62,500, debit the building, $37,500, and credit cash. So a nice review of how to allocate the cost of when you're purchasing more than one asset for one price. On September 1st, Tristar signed a $40,000 non-interest-bearing note to purchase equipment. The $40,000 payment is due on September 1st, 2022, so next year. Assume that 8% is a reasonable interest rate. Well, we need to determine how much is the fair value of the equipment today. What is the present value? We know in a year we'll pay $40,000, but we know included in that $40,000 is interest. So we will take the present value of N is 1, I is 8%. Present value factor is 0.92593 times 40,000 would be $37,037. Debit the equipment for that amount, credit notes payable for the $40,000. The difference is debited to discount on notes payable, the contra account to notes payable. Remember, what does that represent? It's the interest on this loan. But we can't debit interest expense today because no interest has occurred yet. We will remove the interest as it occurs out of that account and into the interest expense. In 3, September 15th, a truck was donated to the corporation. Some more trucks were selling for $2,500. Debit truck, credit revenue, donation of assets. So that would actually be credited to a revenue account. Increase our net income on the income statement. September 18th, the company paid its lawyer $3,000 for organizing the corporation. Expense immediately. Debit organization cost expense, credit cash. On October 10th, Tristar purchased maintenance equipment for cash. The purchase price was $15,500 in freight charges also were paid. Remember, all costs to get the asset ready for its first use. So we'll debit the maintenance equipment account for $15,500 credit cash. On December 2nd, Tristar acquired various items of office equipment. The company was short of cash and could not pay the $5,500 normal cash price. The supplier agreed to accept 200 shares of the company's no par common stock in exchange for the equipment. The fair value of the stock is not readily determinable. Now, if we were able to determine the fair value of the stock because it was traded on the stock exchange, that would have been the amount we debit the office equipment for. But since we can't, we debit office equipment for the value of the office equipment, credit common stock. On December 10th, the company acquired a tract of land at a cost of $20,000. It paid $2,000 down and signed a 10% note with principal and interest due in 1 year. This is an appropriate interest rate. Well, we debit land for the $20,000, credit cash for $2,000, and credit notes payable for $18,000. What's going to be paid at the end? The $18,000 borrowed plus interest. So this was a great review of all of the different ways to determine the cost of an asset. So now we're going to go over to 10.4 on page 561 and look at intangibles. So Horstmeyer Corporation, 10.4, problem 10.4, commenced operations early in 2021. A number of expenditures were made during that year and were debited to one account called intangible asset. So the total balance in that account was $144,000, and here's what was in it. What we need to do is prepare the necessary journal entries to correct this, to clear the intangible asset account and set up accounts for separate intangible assets, other types of assets, and expenses indicated by the transactions. So let's see what we get. The first one, February 3rd, state and corporation fees and legal costs related to organizing the corporation. Well, those should be immediately expensed as organization costs. When they pay the fire insurance premium for a 3-year period, that's a prepaid insurance. It's a whole different asset, right? When they purchase a copyright, they'll debit the intangible asset account, copyright. Research and development costs are an expense. We've talked about that. Debit research and development expense for $40,000. The legal fees for filing a patent on a new product resulting from an R&D project, that would be debited to patent, as well as the legal fee for successfully defending the patent. So someone challenged us and said, no, that's our patent. We won the court case. We debit those costs to the patent account. If we lost, we would just debit them to a legal expense. We really don't have a patent. Entered into a 10-year franchise agreement with the franchisor. Well, that $40,000 is debited to the intangible asset franchise. And finally, advertising costs. Well, that's an expense. Advertising expense would be debited. We would credit this intangible asset account. Now we've properly allocated and identified each one of these in the proper account. So that was a nice review of intangible assets. Now we're going to go to 10-23. Exercise 10-23 on page 557. And I'm almost there. All right. So here we have a self-constructed asset problem. January 1, the Shagri Company began construction of a new manufacturing facility for its own use. The building was completed in 2022. The only interest-bearing debt the company had outstanding during 2021 were long-term bonds with a book value of $10 million and an effective interest rate of 8%. Construction expenditures incurred during 2021 were as follows. So we're going to take each expenditure and determine how long it would have been outstanding during the year based on when the payment was made. So $500,000 would have been outstanding for 12 of 12 months. The March 1st payment would have been outstanding for 10 of 12 months. The July 31st, 5 of 12 months. $600,000, 3 of 12 months, and the December 31st wouldn't have been outstanding at all. So based on how long those amounts were outstanding, we will calculate the amount we should calculate interest on of those payments. So 500,000 for the first one and the second one, 200,000 of the 480, 150 of the 600, and no interest should be calculated on that last payment on 300,000. So of all the payments made this year, what amount should we calculate interest on? 1,350,000. Since the only outstanding debt had an 8% interest rate, we'll use that to calculate the amount of interest to be capitalized, 108,000. Okay, now I know with other exercises you have for your practice, it gets a little bit more in depth with different types of loans. So we just wanted to go over how to calculate those average accumulated expenditures and ultimately how to capitalize interest at what percentage. So make sure you listen to that voice lecture on calculating the interest, especially when you have more than one debt and may use a specific interest rate or may use the weighted average interest rate. If you have any questions on any of the concepts in this chapter, please reach out through email or on the discussion board. That concludes our discussion of these problems.